We're live. Hello, everybody.
Hello. Happy Tuesday.
We just taken a quick break. We're actually changing some flooring in our basement. So we wanted to take a quick break and talk to you guys today about some risk mitigation in multifamily.
We just spent the weekend actually at the Multifamily conference in Toronto.
That was a big event.
Yeah, it was a big event. We just got back yesterday. I think we have like some conference hangover right now. So if we're a little slow, that's why it's, we had a long weekend. So I apologize if there's anything that's seems a little off, but we definitely have some conference hangover right now.
It was a long weekend, but it was a good weekend. There were a lot of good people there. We met a lot of new friends, a lot of old friends as well.
Yeah, good to connect with a lot of people. It was a lot of fun. So shout out if you're watching and you were at the conference. And hey, I feel it if you have the conference hangover as well. We're feeling it too. So don't feel so bad if you're a little bit slower today. But yeah, like Jeff said, we are going to be doing these. We had planned initially to do them every other Tuesday, but I think we're going to adjust that and make it every Tuesday. So
let us know what you think.
Yeah. If you're enjoying them, if there's a specific topic that you want us to talk about, send it over to us because we are hoping now to actually do them every week. So they're a lot of fun. These power lunches, I think, are a great way. You can take your break, take your lunch, but still do some learning during it. So reach out, give us some feedback. Let us know what you want to hear about.
Yeah, and if you can't make it live, we will be posting these up on our YouTube channel as well.
Yeah.
So you can get them there. Yeah.
Or if you want to review something.
Yeah, but the idea is to do like a quick 20, 30-minute little educational video, essentially.
And just like last time, so we do have slides. The slides are more to keep us in line because we can go off on tangents and maybe never come back. So the slides are more for us to kind of keep on track and just so that if you are hopping in kind of in the middle of it, you know what we're talking about. But really, this is supposed to be more of a discussion. So if you guys, it's supposed to be kind of casual. We're going to kind of chat back and forth about certain things. It's not super structured. So
I have the comments up on the side as well. So if you guys want to ask any questions or anything like that throughout, feel free. I'll be looking at that periodically, and we'll get to any questions that people have. Yeah.
So if there's any comments, questions you have, just post it while we're talking, and we'll try to make it a bit more interactive that way. So today we want to talk a little bit about risk mitigation, because with any investment you're doing, there's going to be some risk. Really everything every day has a little bit of risk. So we wanted to talk a little bit about some of the risk mitigation strategies that we have, more specifically in the multifamily investing. I say even more specifically in the buy and hold multifamily investing space, because it's important. So we wanted to chat a little bit about that today. As always, you've said this before, we are speaking from our experience. Like I just mentioned, we wanted to talk about some of the risk mitigation strategies that we have and some of the maybe some of the situations that we've seen in our investing career. So this is based on the
steps that we take as well.
Yeah. So it's based on our experience.
Yes.
We're not professional lawyers, accountants, financial advisors. If you do plan to get into the real estate investing world, I highly recommend you surround yourselves with a really good real estate focused team. So this is from our experience. It's for educational purposes only. Don't go and do anything crazy after one of these presentations.
We are not giving advice.
Yes.
Moving on.
That being said, let's talk about some risk mitigation. So like we were talking about earlier, there's really risk in anything you do, not even just investing.
There's risk walking across the street.
Yeah. You get in your car, you're taking a risk. You are outside gardening. I don't know. You might be taking a risk. But it's about what you do to mitigate that. And specifically, if you think about if you get in the car, what do you do to mitigate risk? First of all, you get educated, right? You learn how to drive.
Get your driver's license.
Yeah, you get a driver's license.
Put on your seatbelt.
Put on your seatbelt, exactly. So you take these steps to mitigate risk.
You're supposed to do a walk around of your car.
Okay,
actually.
I don't know if I didn't know that.
Every time before you get into it, they teach you that in driver's ed. You're supposed to do a walk around your car and make sure that there's nothing like falling off of it or nothing obvious that's wrong with it.
I didn't know that. Interesting. I'm sure I did at one point in my life, but
lunch and learn.
Yeah, there you go. I learned something today. But really it comes down to like, what are those risks and what can you do to reduce those risks? And when you start talking about it, right? Like when you start talking about what those risks look like. I know for us, we talk about it right away, right? We talk
back into
about
the multifamily space now.
Not when we're getting into our car. Not when we're getting into our car. But when we're looking at projects, we start talking about what are the risks right away, because that can help you decide, is this project worth it or is it not worth it? Right? That's kind of your first initial like black or white. Should we do it? Should we not?
Yeah. What are the risks for us as maybe the managing partner? What are the risks for any partners that we bring on that might be financial partners as well?
Yeah. And like, what do you think as far as like who should be looking at those risks? Like, what are these risks for, and like who should be kind of mitigating them?
Well, everybody should be looking at the risks, but ultimately the managing partner should be taking into account all of the risks and basically just telling anybody that's getting involved in the deal what those risks might be and how those risks are being mitigated. Yeah.
And I think it's really important, whether you're a managing partner or you are a passive partner, to understand these risks. So going through this isn't just for somebody who is looking to put a deal together and looking to be active. It's also for somebody who wants to get into a project passively. You need to understand what these risks are, because you want to make sure you know what questions to ask. You want to be able to review what that managing partner has done to be able to mitigate those risks. So understanding these is not just for the managing partner side, it's also for the passive partner side.
Definitely.
So that's why it's important for us to talk about this. So why don't we get into what some risks can look like?
Let's do that.
So again, when you're looking at a project, there can be a ton of different risks, and it can be very project dependent, right? So what are some of the risks we've seen?
Well, I mean, one thing that we always do is we look at what is the vacancy of the area for this building, right? We want to understand what the average vacancy is, and not only just of the larger city, but of maybe the micro the micro area, like what that specific neighborhood. It could be very different. Like talking about Ottawa, you have maybe a vacancy rate in Ottawa, but Vanier is going to be very different from Barhaven.
Yeah, that's true. And it's one thing to, and that's why it's important to know your market as well.
Yes, absolutely.
So it's one thing to just know what the vacancy of Ottawa is. It's much better if you can understand kind of the different neighborhoods, I guess, within that area that you're investing in. And that's why it's so important to know the area.
Yeah.
So with that, there are a ton of different like risks that can be involved with different projects. So this isn't all encompassing. Obviously, we don't want to go through every single risk.
This wouldn't be a 20-minute session if it were.
So, because you want to think about like, if there's a construction portion to it, if there's renovation portion to it, that's going to bring on different risks.
Yeah, budget, timelines.
Yeah, exactly. And then like who those team members look like. Are we relying on maybe tenant turnover to do some of those renovations?
Yeah, and if you're in Ontario, there's higher risk than if you're in Alberta. It's harder to get the tenants out in certain markets.
Yeah. So I think this isn't all encompassing. This is like all like kind of the high level risks that you can see when you're looking at a project. But remember, like you really have to go through your project and say, you know, if this were to happen, what are we going to do? Because if this were to happen, that's kind of where you can find what that risk is. You know, if this project goes over budget, what are we going to do? If this project goes beyond its timeline, what are we going to do?
Or even just down to the basics of, do you have a renovation budget? Are you just guessing what it's going to be? Did you get your quotes? Do you know what your timeline is? Have you accounted for the expenses during that timeline, during the construction phase?
Yeah. Yeah, I mean, it's really important to take that step back and say, you know, do we have all the information? Have we really looked into this? Have we gotten our quotes? Is this realistic? And even if we have gotten a quote, is this realistic with the project that we're doing? So obviously there are a ton, but a lot of the ones that we focus on kind of right away with any project, as Jeff was mentioning, vacancy is a big one. If you're doing buy and hold, your customers are your tenants. So if you have a lot of vacancy and you didn't account for that, that's just like you having a corner store and no customers
There's
show
a
up
lull
that day.
in. Yeah, exactly.
Yeah. So you want to make sure that have you predicted your vacancy correctly, and take a look at that. Unexpected expenses. I think we kind of touched on that a little bit with the renovation piece.
Yeah, a little bit, but you're going to have your regular expenses, and are you accounting for everything that you need to?
Mm-hmm.
Right? Like that's a big one. I find that especially if you receive if I receive a property from a realtor, and this happens a lot, there's a lot of expenses that are left out, right? And we'll get into that I think in a minute. So you just want to make sure that you're accounting for the proper expenses when you're doing your underwriting on a deal.
Yeah. And then I think one that a lot of people don't think about, because they think about the project itself, right? Like they think about
the property, everything that has to do with that property.
All the expenses, your tenants. I think a lot of people don't think about the actual risks of partnership, because I'm sure a lot of people who have been in investing for a while have gotten into a partnership that didn't work. And it's not necessarily that, someone was mean or evil or anything like that. It's just the partnership didn't work. And a partnership failure can even be
goals didn't align.
We've been asked what happens if we get a divorce, right? So that's a risk, right?
Yeah.
That's
what
a
happens
risk
if somebody dies?
Yeah.
Right?
So it's not necessarily like, two business partners were butting heads and the partnership failed. It can also be like you said, what if a partner passes away? Because that is in a way a partnership failure.
Yep.
What happens if we get divorced, right? So these are the types of things that you want to think about when you're getting into a partnership, because there can be some risks with that. So again, all different things that you want to be looking at as far as like, what are the risks of this project? And of course, it's going to be potentially a different risk than this, but these are I'd say the big four categories.
Yeah.
So we can talk a little bit about, we're not going to go into detail with all of them, but we'll go into detail with the major ones that we were talking about. So selecting an asset and making sure
that's a nice looking building.
I know, she's a nice one. You might see a couple of pictures that are very similar to this one throughout. So obviously you want to make sure that you're selecting a good asset, because that's going to be a part of your risk mitigation. We talked about vacancy, right? So if you're not selecting the right asset in the right location, you could be increasing your risk at that point. So mitigating that and making sure that you're selecting the right asset, but not just the right asset in the right location.
You hear it every day in real estate, location, right?
Yeah.
It's a big factor.
Yeah. And sometimes it's a great location, but not for the type of investing that you're doing.
It's true.
Right.
Yeah.
So if you have somewhere that, like Ottawa, say you are a short-term rental investor and that's your thing. You do short-term rentals and you're looking at Ottawa and you buy a property in Ottawa and then you realize you didn't do enough due diligence and you have to live in a property to be able to do a short-term rental.
Yeah, you have to get your license, and there's a lot of red tape around actually being able to do short-term rental.
Yeah. So it's understanding what those risks could be. And then again, with short-term rental, I don't mean to pick on short-term rental. It's just the first one that came up in my brain. But again, there's a lot of places that are putting limitations on short-term rental. So they may not have them now, but they could in the future.
Yeah.
So what ways are you mitigating those risks with your short-term rental? Are you running numbers as a long-term?
Yeah. Can you transition from short-term to long-term, and does the deal still work?
Yeah. So it's not just about selecting like a great location with a great economy and, there's a bunch of jobs and it's growing. It's also about what type of investing are you going to be doing in that area and what kinds of risks can come along with that and how do you mitigate that?
And that specific market that you're looking in, maybe it's not even a good place for a rental. Maybe the majority of people actually own their homes in this one specific area that you're looking, and the rental demand is really low. That means you're going to have higher vacancy.
Yeah, that's true. We talk a lot about like commercial, and commercial, I don't mean like commercial residential. I mean like
commercial retail,
commercial
office space, that kind of thing.
So, because I know that's a discussion that we have even within our coaching group with buying a building that has a commercial component to it.
Yeah.
So do you want to maybe touch on what we do there?
Well, ultimately, we run the numbers with only the actual residential parts of it, and we eliminate any income that would be coming from the commercial space.
Yeah.
Right? Because we don't know how long that commercial space is going to be vacant. If there is a turnover, if it's already vacant, how long has it been vacant? Right? Especially with COVID, there's been a big change in work from home. So there's office space that is struggling right now because they cannot, all these companies are reducing the amount of office space that they actually require, if any. And so there's a lot of office space that's being converted into residential space or just sitting vacant.
Yeah. I mean, one strategy, like you mentioned, is to basically remove the commercial from the equation entirely.
Yeah. If the deal works with just the residential and then you do fill that commercial space, then that's a bonus, right? And now the deal is even better.
Yeah. And I think it's also like, as far as risk mitigation goes, it's looking at what type of commercial space you have in that building. Because like you said, if it's an office space, maybe that's not, maybe that has some higher risk with it. Mm-hmm. But if it's something that, someone can't work from home doing that job, like I'm thinking if you have, even a lot of doctors' offices now, some doctors are working from home.
Exactly.
But there are a lot of procedures that people can't do from home.
Not yet.
I mean, you can only mitigate risk with
mail
as much.
Order robot surgeon.
We can only mitigate as much risk as we know of right now. So we don't know what's going to happen, and we can't predict the future. But
even storefronts are going online.
Yeah.
Right. This dates pre-COVID even. So there's a lot of stores that you can just order it online. It'll be delivered. Like look at Amazon, right?
Yeah. And that's why I'm thinking, look at what that business is. Like, can that business primarily work from home, or do they really need an office, like a commercial space to be operating?
Yeah.
So that could be one way that you look at mitigating some of that risk is what is that commercial space?
Yep.
And can they operate elsewhere, and do they have to be in that space or not? And one thing we like to talk about a lot is size. And this is something that we've recently, I'd say in the last year, did a lot of deep diving on, is like, does the size of the building, the number of units, like, does that make a difference as far as risk goes?
Size does matter.
Why do you say that? Why do you say that, Jeff?
Economy of scale. You actually...
I'm glad you went that way with
it. We're talking multifamily.
Yes.
When you have more units under one roof, then you're actually mitigating a lot of risk. You have more customers. If you look at your multifamily building, let's talk one building. We're buying this asset here. How many customers does that building have? If you compare it to a single family home has one customer, has one tenant. But a building like this has 12 tenants.
Yeah.
Right?
Yeah.
And so if one tenant leaves in your single family home, you're 100% vacant.
Mm-hmm. I always go back to that corner store example, right?
Yeah.
Like would you rather buy the corner store with one customer, or would you rather buy the corner store with 20 customers?
Exactly.
Right? Because if that one customer goes to a different corner store that day, or maybe they're out of town, they went on vacation or something, and now you have no customers.
Yep.
I do want to say hi to Powell.
Hey, Powell.
Thanks for joining us. Yeah, it's true. Like, so from what we've and this is our experience, but from what we can see as far as risk mitigation goes, size does end up mattering.
Absolutely. Well, and then you've got one boiler that's doing the whole building. Mm-hmm. You've got one roof that you need to maintain. Sure, it's a bigger roof. It's going to be a little bit more expensive, but it's going to be less expensive than 12 single-family home roofs. I can tell you that much.
That is true.
There's just a lot. It's one business rather than each single family home, for example, being its own individual business as well.
Mm-hmm. Yeah, and that does make a big difference as far as mitigating risk. Mm-hmm. So obviously selecting the right asset, there are a lot of different things to think about as far as how to mitigate risk within that asset class, as far as like picking the right location for the type of investing you're doing, and what are some like backup options? What's plan B? What's plan C? If something happens with this property and I can no longer use it the way that I wanted to up front, what are the other options with that property?
Yep.
Are there other options with that property? So all of these things will help you mitigate risk. And again, as
talking about multiple exit strategies,
exactly. And even I'm thinking about exit strategies, like what is your exit strategy?
Yeah. hopefully you have at least one.
Yeah. So are you going to be refinancing? Are you going to be selling the property? When are you going to be selling the property? Is there going to be a market to sell that property in?
Yep.
Like, are you the only crazy person that's going to buy that property and you won't be able to sell it again, right? So a lot of different things to think about in as far as risk goes, and then trying to mitigate that. This is a big one. This is a biggie. We'll try not to spend too much time on this, but obviously underwriting is a big place that you want to try to mitigate as much risk as you possibly can, because in real estate, this is a business and the numbers never lie. You don't want to be fudging numbers to try to make things work, because you are increasing your risk. You are not mitigating your risk. So underwriting is extremely, extremely important.
If anything, you want to be conservative, and on your expenses, you want to overestimate what those might cost. Maybe you want to add for inflation as well.
Mm-hmm. You don't want to, I guess, try to create no risk in your numbers, because then you might never purchase.
Oh, you'll never see a good deal.
You'll never purchase anything, but you want to mitigate as much risk within reason. You don't want to make every deal not work, but you also don't want to make every deal work. You want to find that like nice, I guess, middle ground.
Yeah.
One thing I will say up front is make sure that you're using the right numbers, because we've seen, this is probably one of the most common things that we see, is that when you receive numbers from a seller, those like initial, I guess, MLS numbers or like approximate numbers from the seller,
or if they give you like a
with,
pamphlet for it and it's got numbers written out on it.
Yeah. Like, that kind of initial paperwork that you get, that's not, you don't have it under contract yet, you're just doing that quick underwriting.
Mm-hmm.
Often those numbers are going to be wrong because they've been estimated, or they're old, or whatever, or they're not, or they're not going to include everything that you need. Yeah. So I know some of the stuff that we've seen that isn't often included is things like property management.
But you're going to be managing it on your own.
That's never the right answer, because most people, when they get into real estate, they don't want to be necessarily taking on another job. Mm-hmm. So you may be wanting to give property management to somebody else, and now that's an expense.
And even if you want to do it on your own, you should be getting paid for your time.
Yes.
To do that.
That's not something free that you should be doing, because proper property management's hard.
Yeah.
It is not an easy task.
You get calls on Christmas.
Yeah, on Christmas, the day you get engaged. Not that we have any experience with that, but it's hard. So you want to make sure, like, you're on call 24/7, you or whoever you end up getting to do your property management. So you want to make sure that there is a number in there that makes sense for property management. And then even like, I'd say for, we have an example of the underwriting for one of the properties that we have there. When we initially got this underwriting, they didn't have things like the elevator maintenance. They didn't have, which you can see, like, that's a huge expense on there. They didn't have accounting and legal fees, because you're going to have to, especially if you have this under a corporation with a building like this size, you're going to want to, most likely.
Yep.
You're going to have to do taxes specifically for that building.
Yep. Bookkeeping, you have to hire an accountant. This, like, I don't think garbage was on there either.
No, I don't
There's a lot, and we received January to August. We didn't even receive a full year.
Yeah. So again, like,
so
you want to
trust but verify. Yeah. Right. That's the key. You want to make sure that you're checking all of the expenses that the building actually had. So if you get this under contract, you've done your underwriting, your initial underwriting. When you receive the seller's deliverables, you should be asking for all of the expenses that they've had for this property. Mm-hmm. And they should be able to tell you that if they have proper books.
And then you look through it.
And then you
look through it month by month.
You get 12 hydro bills or 2 years of hydro bills, and you look and you make sure that it adds up to be what you've underwritten it with.
Mm-hmm. And the other thing that we add is not just the numbers that you are given as far as like expenses for the building. So things like, the obvious ones like your garbage, your snow removal, your utilities, your property management. Those are like real concrete expenses that no matter what, you're paying those things. But also things like we went back to like last slide is things like your vacancy. So you want to make sure that you put something in there for your vacancy. Look up what the vacancy is for that area and maybe even go a little bit above that to make sure that you're covered if there's tenant turnover and you don't get somebody in right away. Or maybe 1 year it's higher, like vacancy's higher than what they expected. It's going to fluctuate, right? It's an average. So having things like a vacancy expense, having things like a maintenance expense.
Yep. Repairs and maintenance is often left out on underwriting that you receive from sellers.
And things like, light bulbs are going to go. It's going to happen, right? And you don't want to even, I know it seems silly, like, oh, light bulbs aren't that expensive, but it can be a light bulb or it can be an appliance.
Yep.
Which if you
it
have
all
a bunch,
boils down to the numbers.
Yeah, we have a bunch of appliances that go that can be a lot bigger. So you want to make sure that you have a maintenance budget in there, and even if you don't spend it that month, you might consider holding on to it just in case. Next month, maybe those light bulbs don't go in January, but in February all the light bulbs go, and then maybe the appliances decide to go as well. So you want to make sure that you're adding these things in every month. And if you don't spend it every month, you don't necessarily want to just either keep it, like put it in your pocket, or pay it out to your investors, because you might want to keep it in a fund.
Let's talk about insurance. Get your own quote, because when they give you insurance, and we could talk about underwriting forever. So maybe we'll, I don't know if you had anything else to go after insurance, but maybe we'll make this the last thing. You want to get your own quotes, because their insurance is not going to be the same as your insurance. They could be underinsured. So there's additional risk, right? If there was an issue, they might not actually have enough of a payout to be able to rebuild whatever it was that you had. And they might actually have a blanket policy over multiple buildings. You don't know what their insurance policy actually looks like. So they could be getting a discount on every property because they have a blanketed insurance policy across multiple. So don't just use their quotes or their insurance numbers. Make sure you get your own.
Yeah, and actually on top of that, what we've seen in the last couple of years is that during COVID, insurance rates went up significantly.
Oh yeah, for the last few years, insurance rates have been going up like 35%.
So
it's insane.
If you're underwriting a building that, even if they got their insurance like 3 or 4 years ago, don't just assume that yours is going to be like a couple hundred more, maybe for it being a couple of years old. Insurance went up an insane amount. So get your own quotes. Like it's not worth it to get into it. Waive all your conditions, and you can put this as a condition. Like all of this can be conditions that you want to go through and do your due diligence on and mitigate that risk. And it should be, because you're going to want to get a proper insurance quote.
Yeah.
Because that can be a huge expense that you weren't expecting. And now you have this project or this building firm. You have no conditional period where you can get out of it, and you get your insurance quote, and now it's like double. And we've seen a lot of those where it's double what
absolutely.
their insurance was. So that's
because maybe they've had it for 20 years, right? And their insurance has only gone up a little bit with their policy. Yeah.
So it's a big deal. Get the underwriting right. Make sure you use all your numbers. Don't fudge the numbers to try to make it work. Don't say like, oh, like I'll manage it for free to make it work. I'll manage it for free to make it work. Like absolutely not. No managing it for free to make it work. That's not okay.
Yeah. Let's move on. Somewhere.
So this I think is a really big one. This is kind of related to underwriting as well. But this is actually something that Jeff and I will do as a part of our initial raise as well. So when we're walking into the building, we want to make sure that we have a contingency fund.
Contingency, reserve, slush, call it whatever you want it. It's just an amount of money that sits in the account that's ready for disaster, essentially.
Yeah. So this is a huge part of risk mitigation. Because like I said, if 1 month you have a bunch of appliances go and you don't have the money budgeted for that, you're going to want to be able to tap into something instead of having either go into your pocket or go back to your investors and say, hey, like
we need to do a cash call.
Yeah. And then again, if you're a passive investor getting into a property, you want to ask, like, what's your plan for unexpected expenses? Like, do you have a plan? Are you keeping a contingency fund, or am I going to be expected to pay out of pocket if something comes up?
Yeah.
So
very good point.
We start this right off the bat. It's part of the raise, because you never know. It's one thing to build it up, but if you get into that thing in the first month, something happens, now you're back to that square one where you're dipping into your pocket or dipping into your investors' pockets.
Yeah. So
we go in with a contingency fund, and then we also build that. So like I was saying before, if you have a maintenance budget every month or a vacancy budget every month and you don't use that budget, throw it into a contingency fund and make that like a good, juicy contingency fund so that if something comes up, then you have that prepared for. Yep. The other thing actually that's important, I know I'm going back to underwriting that we didn't mention, but it's important, I think, is if you have, because it wasn't part of our underwriting for that particular property, but if you know that in 5 or 10 years, you're going to have to replace a roof, put that in your underwriting. So take the cost
capital
of that,
expenditure.
Yeah, take the cost of that capital expenditure and share it across a couple of years. Maybe it can be like right from the start or like 5 years out, so that again, when you get to needing to replace that roof, you're not now having to dig for, because those can be expensive. So you don't have to dig for money.
If it's going to be $50K to replace that roof, and you know that it's going to go and you have to replace it in about 5 years, then you can save $10K for 5 years rather than having like $50K right out of the, like,
when you have to actually,
it's when you actually need to spend it. Yeah. So you can actually prepare for that, and that will help.
Yeah. And all of this is risk mitigation. And whether you're a passive or an active investor, these are important things to understand, or as a passive investor to ask about.
Yeah.
And then of course, in your partnerships, we'll touch on this really briefly because we dove into this a little bit at the beginning. Mm-hmm. But when you're entering a partnership, have things written down. Don't just like fly by the seat of your pants. Like, have things written down, have contracts written out.
Yes.
Have discussions about risks, about these things, about the goals for the property right off the bat. So
everything should be laid out in your JV agreement or in your shareholders agreement. However you structure your deal, everything should be laid out. What happens if there's a disaster, death, divorce, anything like that, right? Mm-hmm. You want to make sure that all of that is in writing and is understood what happens if.
Yeah. And you can see in the picture, you want to make sure you keep those smiles. You want to make sure those smiles stay, because if you don't do this, sometimes those smiles disappear. Thankfully, this is actually one of our partners. Thankfully, we've maintained those smiles, and it's all because you want to make sure you do your due diligence, set your goals, make sure everybody's on the same page, everybody knows what's going on, and that's going to keep those smiles on your face.
Yeah, it's easier to do it right from the beginning than it is to try and muster something up when an event occurs.
Yeah. The other thing, actually, you brought this up right before, and I added this kind of last minute, was the idea of, I called it partnering up.
Mm-hmm. Yeah, I mean, you want to make sure, like, if let's say you're less experienced, then you can partner up with somebody that's more experienced and leverage that person's experience, and that's going to help mitigate the risk of the entire project, because now you've partnered with somebody that has that extra, that more experience than what you may have.
Yeah, so you're literally like partnering up. Partnering up.
I like that.
Yeah, see? Partnering up with the experience.
Sometimes you're clever, but sometimes it's really subtle.
At least I know in my head. It's all up there.
As long as you laugh at your own jokes.
That's what matters. So we can go over, we won't dive too much more into partnerships, because I think it's pretty obvious, and I know we don't want to take up too much time, but we can go over quickly an example of some of the things that we've done with one of our recent projects to mitigate a lot of risk. We didn't go through every single thing that we've thought of to make sure that we've mitigated risk, but these are a couple of things that we've done on our projects that we do in general. So this is the 24 unit portfolio that we are currently working on. This is actually one of the buildings right here. And we've done a lot this is really important to us, is doing this risk mitigation piece, because we want everybody to be happy and the project to work and all that fun stuff. So some of the stuff that we did with this project is, first of all, we talked about location. So we have this building. It's in a growing community. It's along a major highway. There are multiple sources of jobs for the community.
The economy on its own is very, very strong.
There's new box stores going in. So you see this growth happening. And that growth has a foundation for something. It's not like it's a one-trick pony kind of a town where, they rely on maybe one
industry or something.
Yeah, industry that could be very volatile. Town. Yeah, I wasn't going to say it, but yes, those always make me a little bit nervous. But there's a lot. The economy is robust. It's growing. It's close to a primary market, which is actually the primary market is Ottawa. So it's a strong, strong market. So that alone is mitigating a lot of risk, because we know that if nothing else, this is in a great location. It's close to a really great city. So the asset itself is strong just because of the location. We've done a lot as far as, like we mentioned earlier, is as far as the numbers, creating some risk mitigation. So
the underwriting.
Doing things like vacancy. We have the maintenance budget for this one. We made sure we went through, Jeff did a great job and went through every single expense. I think for the last 3 years. Did you go through 3 years of expenses or 2?
I think 2.
2? Okay.
We had to get 3 for the financing.
Right. We had to get 3, but went through 2 years of expenses to make sure everything checked out. So everything's been reviewed. We got our quotes. We got our insurance quote, which was, I do believe, higher than what we had gotten originally.
Yeah, it wasn't too bad. It was only like $1,000 off or something, but
still,
these were just built in 2018, 2019. So with them being brand new, the cost of insurance just didn't change all that much, but we did get our own quote.
Yeah, got the quote. So made sure all the underwriting was good. We are going to grow. So as we normally do, we're going to grow a contingency fund for this. So we have a contingency fund that's a part of our raise, and we're going to continue to add to that. And that's written out for our partners to see, like, we are growing this fund. You might expect some lower cash flow right off the beginning, but that's because we're growing this contingency fund to make sure that in the future, if anything comes up, then we have that covered.
Hey, Peter.
Hi, Peter. And that goes back to the goals. We know this project. This is a long-term buy and hold. This is a legacy investment. If an investor comes to us and they're like, hey, I want something that's a quick turnaround cash, like a big BRRRR project.
I want my money back in 6 months or a year.
So we say, like, it's great that you have money, but unfortunately those goals don't align with the goals of this project. Mm-hmm. So that is, again, mitigating risk of any tension between the partners in the future, so that everybody has the same goal and is on the same track. So that's a big part of the risk mitigation from a partnership perspective. And we have actually partnered up on this one. So we have partnered with somebody who has a ton of experience.
A large portfolio.
Yeah, in this area. Have done a ton of equity partnerships. They have a lot of experience specifically in the new build space as well. So this project actually comes with, the 2 buildings are brand new, which actually in itself kind of mitigates a little bit of risk because they're brand new buildings. But there's also a lot to build another building on. Yeah. And he has that experience and he has those contacts. So we did partner up on this one to, again, mitigate some risk for ourselves and for our partners. So don't be afraid to do that. Yes, you may have to split some equity or something like that, but don't be afraid to do that. Yeah. And then as a passive investor, that's part of your risk mitigation is who's on the project and what is their
managing partner.
Yeah.
Yeah, exactly.
So that's a big deal. So this is the opportunity that we have going on right now. It is for equity partnership. Again, we kind of discussed it as a legacy investment. So there's still a little bit of opportunity to get in this one. If you are interested in learning more, we can hop on another call and talk about that.
You can use that QR code right there to book a meeting with us, actually.
Yeah. You feel free if you have any other questions, or I guess there weren't any questions yet, but if you have any questions about anything we talked about, we can go more in depth about some of the risk mitigation that we do. Obviously, we didn't talk about everything that we do in a ton of detail, but you got some high level ideas of what risks can arise and how you can think about mitigating them. Mm-hmm. So yes, please reach out. You can find us in all these places. Send me a message. This will also be recorded and put on YouTube. So if you want to go back and watch some pieces of it,
go subscribe to our YouTube channel, please.
Do that as well. And then watch the video. And obviously we'd be happy to chat if anything else comes up. If you want to know more specifically about this project, about the 24 units, again, book a call with us. Anything else?
I think that's it. I know we went over our 30 minutes. I'm sorry, people.
We'll get it eventually. We like to talk. I like to talk. Jeff likes to talk sometimes. And if you have any other topics you want us to talk about,
yeah,
make sure you let
we're
us
always
know.
looking for new content for this type of thing. And if we're going to go weekly, we'll need some ideas.
Yeah. So let us know what you want to hear about. We're happy to ramble on about that as well.
Thanks, everybody.
All right. Until next time.
Take care.